So I'm moving to that side.
Nee, bleib hier. Ja, ihr mehr in die Mitte. Yeah, fantastic. Thank you, Thomas and Tim. Oh, dann komme ich da hoch.
Schwitzt ja richtig.
Okay. Yeah. Great stuff. So, as I think it was Frederick the Great of Prussia said, let's have the tall guys around me, and with that we move. No, that's all right. You know, I'm not always the smallest, but this is I love your scale and ambition, and I think so. So we move on to the final Q&A and wrap up. Let's not forget horses, carriages, and Spülbohrmaschinen wait outside at 1:30, right? And on the way you can pick up your booklet. And you know, if we try to wrap up by that time, Tim will have a few closing words just as we approach a half hour. So, okay, Q&A, please. We start with, yeah, it's the same guys again. So sorry if I get repetition, Robert.
Yeah, thanks. Firstly, congratulations, Tim, for introducing the new board, senior management to us for the first time, and very impressive they are too. If I can pick up a couple of the comments they made over the last day. Adele mentioned when he bids for a contract at T-Systems, if there's a high German component, he does quite well, which presumably means if there isn't a high German component, he doesn't do quite so well. Claudia and Srini mentioned the increasing synergies of a pan-European footprint. 3 years ago, you said no M&A, expanding your existing footprint. Obviously, your comfort zone on the net debt provides some non-flexibility. But is it time now to think more about a wider spread footprint in Europe? Thanks.
Look, the answer is, first, today, all hands on deck. You know, we want to execute on the deals which we have just, announced, and especially our US transaction is super critical for the future performance of that group. The second one is, it is opening up for us new opportunities. I want to evaluate and to understand how we could closer collaborate with SoftBank beyond that. Because I think this gives us a unique opportunity. I admire what SoftBank is doing on the innovation side. I admire what Masa-san does with his telco in Japan. So if we come closer to this one and really leverage the skills as a close partner, and we promise to each other that we're going to do this when this deal is accomplished, this is for me a big opportunity going forward. With regard to Europe, honestly, guys, we have our hedge in the US and in Europe. We do not have to do something in Europe. We do not have to consolidate. And if there is somebody, who wants to be partner with us and want to talk to us, maybe we are open to consider this, to scale up and to build a kind of relevant European player and scale it up. But there's no must to do this. I do not see no urgency to do this. I have no willingness to pay something for this because we have our value on its own, and we have so much opportunity within the group that I do not see at that point in time any necessity. And anyhow, why should I fight against the wind of regulation at this point in time in this environment? Political leaders should be clear what they want with regard to the digital single market first, and then we will react on that one.
Sam, can I have your question?
Yeah, just two questions. First, you just mentioned SoftBank. I was going to ask Torsten earlier. Obviously, DT Capital Partners, you've seen SoftBank with the Vision Fund, pretty aggressive plans and expansion for what they're doing there. Have your discussions with them ever veered over to DT Capital Partners and the Vision Fund while you've been talking about Sprint?
Yes.
And what could it do for you longer term? And then,
look, no kind of discussions at that point in time. We said the focus and the big value is coming from the US, but I hope that at one point in time, with this intensive work which we have in the board together, we will create something out of it. I think both groups can benefit from it prospectively, but it's too early to say. Is there a co-investment? Definitely yes. We have a lot of interest from external partners to go into the next fund with DT Capital and Partners. And I haven't done it, but I will even approach SoftBank on this one, whether they are interested to co-invest.
Can I just ask quickly on the cash flow as well, very quickly, sorry. 2021, you gave the slide, $8 billion at least of cash flow. I guess if we look at TMUS for next year, they were promising $4.5 billion. You could maybe argue that that 2021 target is conservative, or are there bigger moving parts that we're not picking up on in the mix?
I think Mike answered the question already this morning. The simple way to read it is what the US have given guidance for 2019 and not on a longer perspective, and we were not willing to preempt now that space. Number one. Number two, it says greater 8. It doesn't say 8, right? And now it's up to you to make the math whether you believe US will be stable in free cash flow after 19.
We just wanted to keep it simple, 1 to 2, 2 to 4, 10, easy to remember. Fred?
Hi, Fred again from Bank of America. One question we get a lot last few days is, you commented on EPS trajectory on a standalone basis. Assuming the deal in the US closes, let's take 1st of Jan 19 for simplicity, where can we see this EPS trajectory for the next 3 years? And also on that, assuming completion, can you explain how the dividend trajectory could look like? Thank you.
Sorry? Yeah. First of all, I think for the 3rd year, you've seen it on the chart. We said it's roughly, it's not exactly, but slightly dilutive to versus the standalone case would be. And obviously in year 1 and 2, you have impacts. More impact than in year 3 and 4 onwards positive. So what I don't give you now is obviously a number, Fred, because it doesn't make sense. It depends on conditions of the deal closing, timing. You need to make up your mind there on your own. But basically the 2 impacts you will see from an abstract point of view is interest costs burdening that period of time, obviously, and then after closure of a deal, obviously, as Sprint doesn't carry the same EPS like T-Mobile US, you have kind of dilution in there as well, which holds true for the first 2 years. Basically, that's the way to think about it, and we will give you the right update, meaning the details then at closing, because otherwise it's speculation.
So the restructuring costs are outside of the adjusted EPS, but the interest costs related to the front-loaded network integration that Neville is going to do, that cost is reflected in adjusted EPS, and that's what you're seeing. Ottavio?
Just a very quick follow-up and then a couple of questions. So the 15 billion integration costs, none of them will basically find their way in the adjusted EPS. Is that correct?
Correct.
Right. Cool. So now, moving on to a couple of questions. The first one, you reiterate quite a few times that we're talking about one of the payroll reduction is a net on OPEX. But a number of your peers, basically over the last few years, they basically push people towards early retirements. They disappear from the OPEX, but they appear from the CAPEX, from the cash flow through the working capital, because basically you book a big provision, and this early retirements basically get paid year after year. So effectively, it's a net OPEX reduction, but it's not net cash. Could you confirm that for DT will be also net cash reduction, or it will not be entirely 1.5 billion?
The short version is yes. The longer version is, I've given you in one slide, you've seen the net, the cash impact of the special factors. And obviously, there is everything baked in. So the short version, yeah. The long version, as you want to look up the numbers, is that 1.1, 1.2 range reduced to 0.8, 0.9 on the special factors cash, and everything is baked in there.
Yeah, last Capital Markets Day, it was the P&L special factors. This time it's cash special factors.
This is why we put
exactly address this question.
Yeah. That's right. And the second one is on self-financing for the US. That was always the policy until before the spectrum auction. So you given up on that particular conditions, and you started financing the US through intercompany loans. Now you're going back, and I found it a bit surprising, because if the deal goes through, TMUS will be a notch downgraded. So effectively, the access to the capital markets to refinance the debt will be worse than before. So while you pull the self-financing right now, you don't wait for 2 or 3 years, because that will increase your interest costs at the group level.
So first of all, you said T-Mobile US will be downgraded by a notch if the deal goes through. That's not my understanding. What I heard from the rating agencies is exactly the opposite. So they're confirming the rating in case of the deal goes through. So that's number one. Number two, but you're still, in principle, you're still right. What you're basically trading is interest cost optimization versus the risk profile you have at hand. And that's basically when we did the Metro PCS, the playbook was quite simple. In the early beginning, where you have significantly negative free cash flow, which was the case in the first 2 years on that journey, you do the self-funding, you de-risk. Once you see it's coming up, you have the free cash flow, you optimize your interest costs. That was the playbook on Metro PCS, and that is what we copy-paste for the first phase in here for that deal as well.
Okay, so Steve?
Yeah, thanks. It's Steve from Arete. First of all, thanks for injecting some optimism into a fairly pessimistic sector right now. It's hugely appreciated.
Thank you.
First up, just 2 questions. One on free cash flow. Thanks for the sort of honest appraisal of your performance for the last 2 or 3 years. You've clearly missed in certain areas and you've made it up in other areas, but you've landed almost to the euro on your free cash flow guidance. So can you give us an idea of where you've had flexibility? Is it in cash taxes, interest, working capital? You know, where have you made up the shortfalls, the extra capex? Is it just extra EBITDA growth in the US compared with your original plans 2 or 3 years ago? And as you look out, where is that flexibility in your guidance? It would be helpful to understand. And then secondly, just my personal favourite division is GHS. We haven't had a presentation. It consumed 2 billion euros of cash last year. Is that what it's going to do for the next 2 or 3? Should we, in our modelling? Thank you.
Yeah, maybe starting with the second question, the biggest chunk in GHS on the cash consumption is the special factors. Because if you do, for instance, early retirement of civil servants from a legal perspective, you show the special factors, even if the people are from Germany as a segment or T-Systems, the costs, the special factors against that are shown in GHS. So you have that kind of headcount reduction, cash impact completely in GHS. So that's one of the reasons why that bulk is relatively big. But as I said, we're guiding that to decline, not to disappear, but to decline looking forward, again, like from 15 to 18. That's number one. The first question was on free cash flow. Look, the way we do planning, or we've done planning in the last years, is quite simple. And I remember well after Capital Market Days 15, there was some people coming up and saying, we added up all your guidances of your segments, and it's larger than the guidance of the group. And that's true. Because our assumption is you never will see everything kicking in at the same time in a perfect manner. Well, maybe sometime you see it, but let's be prudent in planning. So what you do is you expect that there are some headwinds you don't have expected, and you have to deal with that and keep your commitments. So that's the way we think through our planning. And obviously, for instance, one big chunk and reserve for the free cash flow last year's was what we did together with the US guys after we stopped self-funding, and we optimized interest costs, your point. A big chunk of that was that. Also working capital optimization in various ways. So what I want to tell you is basically what we never do is put a planning together that makes up a number 100 and we go out and guide for that 100, because very often you have to deal with other additional headwinds you haven't in. So that's why I think we were able to deliver the 4-year guidance, and that's how we want to manage the next 4 years.
Should we assume you have that flexibility in interest and tax and working capital for the next 3 or 4 years? I mean, to Ottavio's point, could you change your outlook on self-funding of TMUS to improve the interest cost?
Yeah, there are 2 ways. One way is non-deal. In the non-deal way, we are out of self-funding, right? We are already in that path. So, and that is why you've seen in the non-deal perspective, you've seen the interest cost being stable. So for sure, in the non-deal case, that option, that upside is gone because we used it already. In the deal case, what will happen is basically, we will ramp up significantly interest costs, putting some burden in the first 2 years on the interest side, obviously. And then from year 3 onwards, once you see it being accretive, we might assess the situation again. But to be very clear, for the non-case deal, it's not an optionality in a significant manner. There's still a bit to do, don't get me wrong, but not in that magnitude and size we've seen.
Tim, do you want?
Maybe only one thing to add. We had even some flexibility from the EBITDA. Remember, we had a guidance of 2 to 4%. We came up with a CAGR of 6%. It was funded mainly from the US operations on the EBITDA side, and this even give us some leeway from a free cash flow perspective. So the operational performance was even supporting the development.
Yeah. Okay. John?
Hi there. 2 questions, if that's okay. The first one, I think from time to time there's this idea of a relevant European operator. Who is the group of stakeholders who's sort of pushing behind the scenes for a large European operator? And then secondly, thanks. I hope that was the answer. And then second on the EPS, could you just help us on the accounting? In the 2017 base, what's the sort of Europe EPS and the US EPS contribution? And then in 2021, what's the expected split US versus Europe on the €1.20?
Look, if you would ask Thorsten, if you would ask the team, and where should we allocate an additional euro? The answer is very simple. We should allocate it to the US. And we consequently did that. So over the past, it was absolutely the right thing to do, and there are a lot of reasons for that one. A more liberal market, a market where you own the spectrum, a market where you really have the opportunity to get the money back and have predictability for the investments which you're taking. The environment in Europe as it is. I think after 20 years of heavy regulation, we have to see a change, and I will not get tired to work on these people. I always told you, I spend 30% of my time with leaders, with regulators, with political guys, to convince them. I have a say, because we are the most relevant telecom operator by size in Europe, even by size now with our foothold in the US, and therefore, at least, people talking to me. Whether I listen to me is another topic, but at least that is something, because I think if you look to the development of our markets going forward, size matters. It matters on the procurement side, it matters on the 5G deployment side, it matters on the innovation side, it matters and even it matters to enable all the adjacent industries which are dependent on the digitization of society. And there is a reason that we have an underinvestment of Europe, quoted by the European Commission of 700 billion, across the 28 countries. Now, therefore, I'm fighting for that one. But look, we have now put our telecom into a position that we are not only dependent on Europe anymore. We have now at least 60% of our profitability EBITDA in the US, in a US environment, which makes us more independent from the European landscape as we're operating. With regard to a European player, honestly, this industry is talking to each other, but I do not see any kind of tendency that there is consolidation taking place at that point in time. We still have the BT asset, and we thought at one point in time that this could be part of DT and would strengthen our position. But Thorsten was very clear on that one. It's not the time, to go out of that assets. No, it's the time, to step out of this business. It's now the time to see that all the measures, all the ideas, all the programs from Novator and the like, get implemented and secure the value of this asset and growing it over time. And then we will see what's going on. It's part of our pension fund. It's working for us from a debt perspective here in the company, and it's good where it is today, but nothing additional to say on M&A or steps going forward.
Okay, on the earnings per share question, we don't provide this, let's say, breakdown. And I would say that probably, it's kind of a 50-50 roughly, but within a fairly wide range. Jacob, maybe?
Hi, Jacob Bluestone from Credit Suisse. So I've got a question on the net debt to EBITDA comfort zone that you mentioned. In your slide you showed, and I think you showed it before as well, that you'd be outside of your comfort range for, I think, 2 or 3 years. Do you feel any sort of pressure or desire to perhaps look at some asset sales or things like hybrids to get that down quicker? Or do you feel it's okay being above the comfort zone for, call it 3 years?
The latter. We are convinced that the execution, after the deal is closing, the execution and delivery of the US team is excellent, and that will bring us in a very fast manner back to, you know, that track being. Sorry, Mike, for putting some pressure here. No, but seriously, you know, you've seen the playbook. But basically, being out of the comfort zone for 2 or 3 years doesn't mean that you not from second year on have already positive dynamics towards getting back. And once you see that dynamics, you can stay cool. And that's basically where we are.
Excellent. So I think
why you're so conservative on this case? I'm more optimistic on this case in the US. I can tell you. That looking to the Metro PCS experience, we have done together 5 of this intra-market consolidation on mobile. And in all of the 5s, you know, where I was part of it, we achieved the cost savings earlier than projected. Transaction costs, we were conservative because there's a lot of, let's say, things with the refinancing of Sprint debts and which are laying in front of us. So even, you know, from the integration costs, we are on the conservative line. I think it's good to be at that point in time. But my experience tells me that if you focus on cost, if you focus on this case, it's coming earlier, it's coming hopefully cheaper. And then you get the benefits already earlier on all of the KPIs. That's my stomach telling me, but we laid out a conservative plan because we want to deliver or over-deliver than rather underperforming. And therefore, I think there is some evidence that we can do it better.
So I think, Tim, we should now maybe conclude with your a bunch of final words of wisdom from you.
Good.
So that everybody can
guys,
catch that.
Yeah, there is not so much to say with regard after 24 hours with us here and with Hannes. You might ask, why has Hannes changed the site and moved out from your community into our community? The answer is not because of the team. The answer is because of this, you know. These are the ladies around Hannes, you know. He's surrounded by beautiful, very smart, intelligent ladies. And I can tell you, and these ladies were not only here for, creating a huge hospitality for all of us and for you especially. They were even, you know, working very hard over the last months on this Capital Markets Day. I like to thank the team around Hannes very, very much for this intensive work. We will see whether it's worth it. We are convinced it's worth it. And I like to even thank Hannes. I know you had a tough time, especially with me. But you know, Qualität kommt vom Quälen. It's impossible to translate that.
Quality comes from
but that said, thank you to all the people making this event happening here at Bonn during this event. Thank you.
Thank you. Yeah.
Look, leading comes from leading. If you want to be the leading telco, you have to do things which others don't do. And by the way, it is very easy to manage this company without any risks. Just move on. Don't do things differently. There is no need to do Sprint. We have a great asset in the US, and it will perform, at least until the end of my tenure. So I can be easily bureaucratically administer this business here. There is no need to do this. But if you want to create value beyond what everyone else is doing, you have to take risks. You have to behave entrepreneurial. And you have to do things differently. You have to lead things. And this is the aspiration of this team. This is what we're trying to do. And sometimes, yes, we might sound a little bit, let's say, too bullish. But at least we believe in growth. In this industry, nobody's talking about growth anymore. Why? Is it a given that this industry has no growth? We always have this bias and this confirmation bias that this industry is a disaster. We don't have that. Everybody told me, sell the US. And then we found these guys, like Mike, like John, like Neville, who said, who says that? And now this business is growing with a CAGR of 11%, year over year. And every quarter, you're coming, growth is over. Growth is over. Confirmation bias. We don't have this confirmation bias. And by the way, you can believe what you believe. We believe in our growth. That's what we're doing. And we were able, since 2015, to deliver this growth. First in the US, then in Germany, now in Europe. 95% of our business is growing. And I can tell you the trajectory for this year is even stronger on the growth. So therefore, here you have a team that's believing in growth of telco industries, wherever we are operating. Second, we are now in the phase monetizing what we have invested. So we are not going beyond what we think. So you can tell me, Tim, you have to invest more. By the way, who can tell us that we have to invest more? Who? There is no king, or there is no somebody who can say, you have to invest into Bavaria or wherever. It's a commercial decision which we are taking. And by the way, you would not find entrepreneurs as leaders of these companies if somebody would say is invest more. Investment is a function of customer demand in a combination with commercial monetization possibilities. The capability to make money out of that one. If we are losing money, why should we invest? So therefore, another bias in your industry that we might have to invest more. No. We say this is what we're doing. In some circumstances, we could make more out of it. In some circumstances, we can make less out of it. But take the investment level as granted, which we have promised. And thirdly, it's all about people. The only reason for this session is not about this 283 pages. It's about giving you the trust that we have the right people on board. And you should make your judgment whether you think we have an attitude which is handling your money properly or not. But the only thing I can tell you is, this is the best team Deutsche Telekom ever had. From an operational perspective, from an age perspective, from a knowledge perspective, and from an attitude perspective, which is for me the most important thing. Both sides of the Atlantics. Being in the US, an experienced team is now with Mike and others, getting younger and even more agile for the next challenges, and being our team with 3 new heads on the operations sides. With a very robust private equity guy who will change transformation, speed into systems. With a very smart guy, I have to challenge him more because he is always so relaxed. Srinivas Gopalan, who is bringing back this growth engine to Europe. And with Dirk, who is very experienced, not only in the business, but even in the political arena, when it comes to all his experience from wholesale, regulation, and politics. So I think we have a great team on board who will manage the expectation going forward. So therefore, we believe in what we are doing, and you can trust us. What we say is what we do, and we will walk the talk. And I'm happy that you have had the time with us and really be curious about what we're doing. Thank you for coming here. And now, nice weekend.
Okay, so goodbye to all of you, and thanks again for coming. So I've joined the, thanks of Tim. And by the way, we made fun about what people are doing first thing in the morning. Earlier, some, say hello to their wives, and others, read some specialist sales. So we listen to all of you. We read all of your stuff. You matter to us, right? Very good. We really enjoy the dialogue. And thanks for coming. And have a safe trip home. See you later.